Welcome to this explainer. Look, we are exactly 1 month away from the biggest leadership change in Apple's history. And we aren't just talking about a simple changing of the guard at the corner office here. We're going to unpack how one of the world's most valuable companies is, well, kind of at war with itself right now. We'll explore how Apple is desperately trying to balance these record-breaking sales on one side with historic, just unprecedented financial drops on the other. It's a fascinating dynamic, so let's jump right in and map out exactly what's going on behind the curtain.
Okay, let's kick things off with this absolutely staggering figure, nearly $110 billion in recently posted quarterly revenue. I mean, that is a massive number. It represents a 16% increase year over year, and it actually beat analyst expectations. If you just heard this metric in a vacuum, you'd probably think, wow, the company is in absolute hypergrowth, just riding this massive wave of unstoppable consumer demand.
But immediately contrast that with a shocking $500 billion market value wipeout. And the crazy thing? This wasn't some slow, gradual decline over a fiscal year. No, this massive erasure of wealth happened in just a single week following a disappointing forecast. The stock took a historic nosedive, dropping nearly 10% in after-hours trading. So you really have to ask yourself, how on earth does a company pull in $110 billion in revenue, yet watch $500 billion vanish from its valuation almost overnight?
Well, that brings us to part 1, the AI chip squeeze and a massive supply stranglehold.
So what actually triggered this massive dichotomy? The answer isn't a lack of consumer demand for iPhones or MacBooks. The real root cause here is a major supply stranglehold. In fact, industry insiders are literally calling it a once-in-a-century flood when it comes to memory chip costs. See, for decades, Apple has operated with incredible leverage. They buy components in such massive quantities that they basically get to dictate the market price. But, the game has fundamentally changed. Today, Apple is being aggressively outbid for NAND and DRAM. Those are the essential storage and active memory chips that power literally every single device they make.
And here's the wildest part of the whole situation. They aren't being outbid by their traditional rivals like Samsung. No, they're being outbid by AI data centers. Tech giants like Microsoft and NVIDIA are just buying up every high-bandwidth memory chip on the planet to train their massive artificial intelligence models. Because of this, the supply is incredibly tight. Apple is effectively being forced to pay a huge premium just to get the basic foundational parts required for every single Mac and iPhone rolling off the assembly line. The cost of goods sold is rising dramatically, basically catching Apple right in the middle of this massive AI hardware gold rush.
Let's move to part 2, the leadership shift, and what is looking to be a very rocky transition.
This macroeconomic turbulence is really setting up a wild contrast for the upcoming CEO handover happening this September. Tim Cook, who just delivered his final earnings call, gets to walk away on this bittersweet, triumphant, and record-breaking $109.4 billion high. But meanwhile, you have the incoming hardware engineering chief and future CEO John Ternus inheriting a completely different landscape. Now, Ternus is a brilliant hardware guy, right? He knows the supply chain inside and out. But he's stepping into an absolute supply chain nightmare, skyrocketing component costs, and a market where consumers are starting to seriously push back against the famous Apple tax. That premium price tag we always associate with the brand. Ternus basically has to figure out how to keep those margins high without totally scaring off buyers.
Which leads right into part 3, from budget Macs to foldables. Let's look at their new hardware strategy. To survive all this, Apple's hardware strategy is effectively splitting into 2 totally opposite extremes to maintain volume while still pushing the limits. On the aggressive volume side of things, they just dropped a shockingly low $599 MacBook Neo and a stripped-down iPhone 17e. That phone is essentially a bridge device that keeps the A19 chip but strips out the Pro camera features. This budget strategy is pretty clearly designed to keep manufacturing plants busy and hook new users into their ecosystem. But then, way over on the ultra-premium end, we're looking at an iPhone 18 Pro featuring a massive generational leap in processing power to the A22 Bionic chip, plus significantly improved sensors. And even more exciting, rumors are strongly pointing to Apple's first-ever foldable iPhone. Mock-ups show this clamshell design engineered with Apple's hallmark titanium finish. Word on the street is the engineering is reportedly complete, and they're currently testing the hinge mechanism right now.
So, what does this mean for us? Part 4, the $300 price hike. Are they hitting the ceiling?
How does this macroeconomic tug-of-war actually impact your wallet? Well, unfortunately, the consumer is likely going to be the one absorbing these new costs. Because Apple is paying such exorbitant memory rates to compete with those AI data centers we talked about, Asian supply chain rumors are indicating a massive $300 price hike is on the horizon. That kind of jump pushes a fully loaded iPhone 18 Pro Max well over the $1,600 mark. And honestly, this is a really dangerous game for them to play. In a globally inflation-heavy economy, we all know consumers are incredibly price-sensitive right now. A $300 hike seriously threatens to kill the highly anticipated super cycle of users who were finally looking to upgrade their older phones. It's definitely leading investors to worry that Apple might have finally hit a pricing ceiling.
Let's shift gears a bit to Part 5, Surviving the Storm. Let's talk about Apple's safety nets.
Despite those inflation fears and pricing ceilings we just covered, we do need to look impartially at Apple's built-in safety nets because they are substantial. I mean, they've weathered severe crises in the past. Just think back to the 2016 Bengate controversy or the total supply chain collapse we saw in 2020. First off, they are heavily reliant on their services division. We're talking Apple Music, Apple Pay, the App Store. This sector is breaking records and it provides high-margin revenue that simply doesn't rely on those expensive, hard-to-get memory chips. Second, that $599 MacBook Neo, that is a vital ecosystem gateway product. It brings in millions of new users who will, inevitably, subscribe to iCloud and buy a pair of AirPods. And finally, you can't ignore their ultimate safety net, a staggering $200 billion in cash reserves. They can absolutely afford to ride out this chip shortage, even if it means taking a hit and sacrificing those tight margins for a year or two.
So as we look toward a truly defining September, bringing with it a brand new CEO and a radically diverse portfolio ranging all the way from a $599 budget laptop to a nearly $2,000 foldable phone, we have to leave you with this $500 billion question. In an era where AI is completely driving up the cost of basic tech components, can Apple continue to charge a massive premium and weather the storm of these high memory chip costs? Or are we about to witness their legendary profit margins finally start to shrink? It's a fascinating crossroads that is absolutely going to define the next decade of consumer technology. Thank you so much for joining me for this explainer. Keep analyzing, keep learning, and I'll catch you next time.